He is a world-acclaimed economist and Nobel Laureate who has left an indelible mark on the landscape of financial econometrics. His groundbreaking work in Financial Times series data won him the prestigious Nobel Memorial Prize in Economic Sciences in 2003. His research has produced various innovative statistical methods that are now widely embraced in finance and provides a sophisticated framework for analyzing volatility in financial asset returns. It is with great honor that I introduce my stakeholder for today, Robert F. Engle III. Rob, thank you so much for being on the program with us.
It's nice to be here with you, Shireen.
We have so many things to talk about, and I thought we could start in the beginning and talk about the post-banking crisis, the CDOs, and the subprime collapse, and the comprehension of the level of risk that was taken. Because recently I saw a few banks collapse in the US, the Silicon Bank. And so I wanted to start with what your views on what happened there, and are we still needing to improve risk management for financial institutions?
Well, that's a big topic, isn't it? I think last time I was in KL was just in the middle of the banking crisis, and we still talk about it, and it's a topic of lots of research. What basically happened was the banks and the financial institutions took on excessive amounts of risk, because by taking on this risk, some banks failed, Lehman failed, many other banks needed to be bailed out by the government. GDP took a big hit, and it took us a long time to recover from this. So banking crisis is very costly. So what really was the cause of it? Why did they take excessive risks? Well, I think there are really two main themes. One is that they actually had a lot of incentives to take risk. And one way to see that is that when a bank fails, it gives lots of damages to the economy way beyond the damages that the owners face. The owners are really only seeing part of the risks from a bank failure. So it's natural for them to take excessive risks. And of course, if they have guarantees and if they think they're going to be bailed out, that's a further reason for this to be the case. But I think a second reason, which is quite interesting to think about, is that they didn't perceive the risk very well. There was a lot of failure to recognize how risky things were. And that's a topic that I talk about a lot in my class, because it's when I talk about volatilities, I talk about risk management and how do you measure these kinds of risks and what's wrong with the way they were being measured before. Therefore, to reduce the probability of a banking crisis in the future, we want to reduce these incentives, but we also want to improve risk management. We passed sweeping legislation as a result of the banking crisis, the Dodd-Frank bill, which I think has helped. But in fact, a lot of that legislation has been undone on the grounds that, gee, we haven't had a crisis recently. And that obviously is not a good enough explanation for why you should undo this. So what was wrong with the way risk management was being undertaken before? Well, I think one of the reasons is that risk was not thought of as something that changed all the time. And so a bank might decide that they could make a loan because there was some probability of default that they thought was tolerable. But lo and behold, what happened is the probability of default went up. And so they didn't think about that as part of the risk. I like to say there's a risk that the risk will go up.
Right.
It's another risk. It's a risk that they didn't pay attention to. And so we began, so this is one of the reasons for doing the kind of research that I've done on time-varying volatilities and how do they change. You don't want to know just what's the volatility on average. You want to know what it is today and going forward from here. And so it's very important to base your risk measures on current estimates of what the risks are and what they could be in the future.
I know you're doing you have VLab. I just wondered, what exactly was VLab doing in terms of scenario or stress testing? And could you share a little bit about some of the progress within VLab?
Be delighted. VLab has really started during the financial crisis, and it was started for exactly this reason, because people needed to know what risk measures look like over time. And so VLab is designed to make available publicly. It's a public website which updates every day and has measures of risk of lots of things like volatilities and correlations that we understand, but also more advanced topics. The idea is that everybody, whether they're in New York or in KL, can log into this website and see it. And it will show you lots of different things. It starts with a map of the world where you see where is volatility high and where is it low today. We have data on maybe 10, 15,000 assets that we pull every day from stock and currency and commodity exchanges around the world. And we update every day. And so everything is current. We estimate these models every day. Some of the newer things that we've put in there are measures of liquidity in financial markets that are changing all the time, and measures of risks like geopolitical risks that are changing over time. So we have ways of calculating those, and this can be quite useful. But I think the topic we should turn to now is what you mentioned, which is stress testing, because we do a lot of stress testing and scenario analysis in VLab. We started this really during the financial crisis and are doing something related to what central banks all over the world do, but it's a little bit different. We do have market-based measures of bank fragility. That is, we'd like to know if the stock market collapses like it did in 2008, will the banks be able to survive, or are they going to have to raise new capital? Mm-hmm. And so we estimate really what the market does to the stock price when the stock market falls. And typically bank stocks go down, but sometimes they go down a lot more than others. This is what we call the beta of the bank. And that's a way of estimating what would be the consequence of a big market decline. That's a way of measuring the exposure. And then we go ahead and say, does that actually put them in a hole that they can't get out of?
Right.
If they really need to raise new capital, how much would it be? And we estimate that, we give it a name, we call it S-risk. And S-risk is one of the really useful products that came out of the financial crisis. And if you look at you mentioned Silicon Valley Bank. If you look at the history of Silicon Valley Bank, what you'll see is S-risk started to go up for Silicon Valley Bank, which means it needed new capital, long before it became a public feature and failed. And so how does that really work? Well, basically, investors who are buying stocks in banks pay attention to how these banks are doing. They noticed that the bank had a lot of its assets in treasuries, and they presumably also noticed they had a lot of uninsured deposits. The treasuries go down in value when interest rates go up. And so fighting inflation was bad news for Silicon Valley Bank and banks and similar banks. So we saw measures giving advance notice of what happened. Regulators didn't seem to see it because they had been allowed not to look frequently at the mid-sized banks. Only the big banks got regular scrutiny. So this is an example of how the legislation didn't really help us out.
Okay.
We also ask a question: how much risk is too much? Or in particular, how much S risk is too much? Can an economy stand certain large amounts of S risk? And so we actually calculate the capacity for each country for the total amount of S risk that it can stand. And from that, we calculate the probability that a financial crisis is brewing, I guess.
Okay.
And so for these mid-sized banks, it was about 50%. So it was not really so high, because during the financial crisis, it was like 90-some percent. So these are tools that I think should help the banking sector police itself, and regulators to police it.
Oh, that's fantastic. So the S risk can actually, it's a predictive capability, and it can be used large scale, so for countries as well as for FIs.
That's right.
Well, that's really great. If I can just move to your ARCH model, one of the big issues, today, of course, is climate risk and long-term climate risk. And I just wondered, whether your model is also looking at transition risk. And I know this is very exciting work. It's something that governments need to start looking at and using. So I wondered if you could share this.
Absolutely. So I mentioned a lot of different kinds of risks that we study at the Volatility and Risk Institute. But actually, we're probably spending more effort on climate risk than any of the others, because this is a big risk for investors, it's a big risk for economies, and it's a big risk for the world. So the way we have approached this is we're interested in what sort of a portfolio should an investor put together if they're worried about climate risk. And this is not to say they want to solve the problem of climate risk, but they want to know what's the best portfolio for them to hold in the face of climate risk. And the answer that we think is good for that is that they should form a hedge portfolio, which is a portfolio which will do better than the market if the climate gets really bad. But if the climate heals itself somehow, then it will underperform the market. And this is a portfolio which would be overweight assets, stocks, and whatever that are prepared for climate change, and underweight stocks which are not prepared for climate change. Sort of a logical thing to do if you're worried about climate change. But of course, what you're really worried about is that it's going to be worse than the market expects, because some of that's already going to be priced into the assets you buy. So we call this a climate hedge portfolio. Over time, if the climate does get worse, you would expect the companies that are prepared are going to go up in value, and the companies that are unprepared are going to go down in value. So this portfolio is going to appreciate. So if the worst happens, this portfolio should do well. Okay. So there are many versions of this available publicly. There's so many sustainable investments. Nobody knows how to judge whether they're any good or not.
Correct.
Some of them are done based on firm characteristics like ESG and sectors and stakeholders are an important part of that, as I'm sure you know from the name of your podcast. But there is another way too, which is to do it based on statistics, which is try to see, when there's information that the climate's getting worse, which stocks and which funds go up and which stocks and which funds do not. Because that's sort of the market's view of the greenness of this portfolio. Right. So we have constructed several of these at the VRI, which we follow on a daily basis. And we think that this is a useful way of characterizing lots of assets. In other words, if other funds that we've not selected or put together are correlated with this fund, especially once you've taken out standard risk factors, then this is a sort of a green credential.
Okay.
And individual stocks that are correlated, that after you've taken out standard risk factors, would also have a nice greenness credential. On the other hand, if you short this climate hedge, then what you're doing is you're overweighting the energy companies that are going to do badly, and you're underweighting the green companies. So you expect funds that are correlated with that portfolio to be the brown firms and the brown funds. So this is a way of sort of checking to see whether your portfolio really does have hedge characteristics to it. And if you look at these hedge portfolios, they of course have prices which are changing all the time, but they're changing in response to climate news, among other things. And so one of the things that is useful is to look at the volatility of those portfolios, and we can use the Arch and the Garch statistics and so forth to see how volatile they are, which is a measure of how fast climate risk is changing.
Okay.
And then it's a very short step to say, well, if we can ask how green a portfolio is, we can ask how green a financial market is, a financial firm is. We can look at the banks to see, are they green or are they brown? Are they making loans to renewable energy and green companies, or are they making loans to fossil fuel energy companies? And
Right.
so that immediately gives us the tools to do climate stress tests.
Okay.
Which we are doing using the same banks, the same data that we do for the S risk. We now calculate what we call C risk, which is a climate measure of the same thing. It's a measure of how much capital would a bank need if there is a climate disaster and its capital erodes because of this. So central banks all over the world are trying to figure out how to do this, and we have it on our website for all these thousands of banks, and it updates every day, and there is a lot of interest in how that's really looking. At the moment, we see some places where there's a lot of C risk, but a lot of places it's not too severe. The banks are really not too exposed to climate change, and that's a good thing, because really, if climate risk is a cause of the next financial crisis, it means we're getting double jeopardy.
And do you look at C risk for countries? So countries that may be dependent on fossil fuels as their source of revenue?
We've not done that yet. And the reason why is because we don't have any experience yet with countries that have had a financial crisis because of having too much C risk. We could use data on past financial crises to tell when there was too much S risk.
Oh, right.
But we can't do it for C risk yet.
Okay. If I just look at, climate risk and stranded assets as well as asset pricing, do you think that you could share some policy implications that you see both at the firm level and a country level and even at global levels?
Yes, I mean, that's really the goal of all this, to figure out what would be good policies, because climate change will have its worst effects in the future, probably the distant future. It's important to see what signs there are of that today. In other words, investors, companies, managers, everybody looks forward to what could happen with climate change, and we make decisions today based on that. And those decisions move asset prices, and they move money.
Yeah.
They move resources from one sector to another. And that's key, that is what happens. One of the risks that I am now very interested in is what I call termination risk. And this is a risk that a company would face if in the not too distant future, its business is really going to disappear. It's a pretty simple idea, but it has a lot of ramifications.
Sure.
And I think it's particularly appropriate for understanding fossil energy, because the fossil energy market is actually pretty strong right now. The energy stocks have been up for the last year. They were up quite a lot. Their earnings are up. And this is sort of viewed as a failure of sustainability. But I think there's another interpretation of that, which is useful. If you're the CEO of a fossil energy company and you think that your life expectancy is not going to be more than a decade, say, what do you do? Well, one thing you might do is underinvest in the future, especially in long-run projects. Projects for drilling and opening new wilderness areas and so forth have really slowed down. The number of drilling rigs has gone down substantially, I think around the world, but certainly in the US. I think there's a lot of evidence that the fossil energy company is not expanding the way it used to. The consequence of that is that your net income actually goes up because you're not spending as much on all this drilling.
Yes.
So all of a sudden you look more profitable than you did before. The other thing is that the amount of oil and gas you supply is probably going down.
Right.
And that also makes the prices go up. So we see high oil and gas prices and high profitability. And to some extent, we see high stock prices.
Yeah.
But investors, I think, also see termination risk for the sector, and they do not reward the company as much as they do technology stocks or other sectors for increased income. The price-earnings ratio, which is in many ways a key indicator of value, is very low for energy companies. It's the lowest sector and typically has been for a long time. It's now around 8 in the US. So you can think about that as an 8-year horizon of earnings that the investor expects from this company. So I think there's a lot of evidence for this kind of termination risk is actually driving asset prices today, and it's driving them in a way which makes energy prices high and earnings high, but is still leading to a termination point. And I think if the energy CEOs look at the net zero commitments that have been made in Paris and are being made and restated just now in Dubai at COP28, they must see that this is a real possibility. But there's more to be said about this. I think it's an interesting idea, and it applies to countries as well as to companies. If you think about countries that have a fossil energy sector, which is the most important sector, like the Middle East, they face termination risk with some options. What are their options? They're trying to diversify. They're using resources that they have to diversify into tourism and culture and other kinds of manufacturing. And I think maybe they will also be big sources of green energy at some point. They are taking a very forward-looking view on this, and I think this is why Dubai wanted to host the COP28. Another country that faces this kind of termination risk is Russia. But Russia has chosen a different way to try to diversify its economy. It's trying to use this illegal, inhuman, inappropriate war to take over Ukraine, all its grain growing capabilities, its natural resources, and its productive population. And so I think that climate incentives have actually been part of the motivation for Russia to start this war. This does not justify anything. It is an inappropriate, I think, way to respond to this termination risk, but I think it helps us understand the struggles. And I think the consequence of this looks a lot like the energy companies. They've reduced supply, the prices have gone up, and Russian oil is selling at a premium now just because everybody needs it.
Needs it, right. Absolutely.
So there's one more thing to say about termination risk, and that is from the planet's point of view. There is a possibility that we will make the planet uninhabitable, and it will be termination time for the human race. This is not to say it's a high probability, but it certainly is a possibility. And when you start planning for the future, you really have to take these kinds of risks into account. Right. How do we do that? We can't really diversify the planet. Well, all we can do is reduce the probability of this happening. So if we reduce the probability of it happening, that would be a success. Right. How do we do that? Well, we have a roadmap from the Paris Accord. We have net zero commitments. The roadmap says if we can all reduce our emissions down to zero by some date like 2050, we will avoid the worst parts of climate change. And I guess that would include the termination risk. It's not that easy to get there. And we're seeing that it's hard to get there. And one of the problems that we obviously see is that it's easy for countries to be free riders on this. Yeah. Countries that don't do their share, but if everybody else does it, will save the planet and they'll get the benefits. So all this negotiation that happens in these COP meetings and the pressure that we put on each other to do this is because only by working together are we going to have a chance to solve this problem. I think the costs won't be that great if we do work together. If we don't, they'll be disastrous.
No, absolutely, Rob. I mean, I think that some of the concerns that I see is that it's so fragmented, in the views. It's so fragmented how people are approaching things. And many pension funds, the large pension funds are still owning fossil fuel companies because they're under pressure from their policyholders or members to get, good dividends. The amount of money that's going into green technology, is not enough for it to be completely reliable just yet. And of course, then the other bit of the puzzle is consumption. You're seeing all these everything's fast now. And so people are consuming more. So as you said, I think it's coming together. It's getting governments to talk and agree. I mean, already at COP28, you could see quite a few countries not agreeing to some of the terms.
Right.
So as you say, we need everyone to come together so that we can do this in an equitable fashion. However, it is definitely a topic we need to keep talking about. I wanted to thank you so much for sharing your views. I think this is really very, very informative, and I certainly hope to welcome you to Kuala Lumpur soon.
Well, thank you. It's been a pleasure being with you today, and it would be even nicer to be there in person.
Thank you very much. And that was my fascinating chat with Robert Engle, who explained various aspects of the banking system and risks. He told us how his S-risk model, developed in the V Lab and running daily, is able to measure risk and volatility for thousands of assets. It was even able to predict the Silicon Bank collapse well before it happened. Several of V Lab's climate portfolios are also capable of hedging transition risk and physical risk. Robert shared how his award-winning ARCH model provides a metric for these changes. These insights allow investigation into whether banks and other financials are exposed to climate risk. They ask how much a bank's stock market price may change when climate risk portfolios change. The world-famous econometrician also shared how he watches for termination risk at company, country, and the global level. Our financial sector must understand these risks and learn how to manage them. I am Shireen Muhiudeen. Join us next time on Stakeholders with Shireen.